The incredibly powerful non-farm payrolls number came in at 353,000 and it shook the markets, especially post-session. In this video, I'm going to help you to not only go through the latest news and understand it better, but to give you a much better concept on how to create 3 simultaneous strategies, a down, a neutral, and an up strategy that play out all the time. Always remember that you control the trade or investment, but the market controls the return. If you are synchronized in with the market, you will make money no matter what happens. You will find that the interdependencies between the Tier 1 charts, the Tier 2 chart structural levels, and the Tier 3 chart structural levels are an absolute game changer. When you understand the structural levels and how price moves, you can make money no matter what the markets are doing. And you will find the more volatility inside the markets, the more you can make. So let's get you synchronized in with what happened in the last session. Hi everyone, I'm Ken from CryptoTradingKS. If you're new, a very warm welcome and welcome back, CTKS family. My goal is to assist you to become more of a financial and emotional blessing to yourself and those you love, gaining real wealth and positive excellence in the process. Here you'll learn where the algorithms are buying and selling so you can profit like smart money. If you find the content useful, please like and subscribe. We'd love to have you as a part of our global family. Let's run the numbers. Things are likely to get very turbulent across 2024. It's likely going to be a chaotic year. The truth is, in markets it's always chaotic. Everything is going up and then coming down, going up and coming down. You want to get on the right side of the percentage. If you buy around the right areas and sell around the right areas, it doesn't matter what the market is doing, you're going to be doing very well. Turbulence is never an issue, unless of course you're investing for the long term. And then it's so much more important to know your structural levels. Talking about your structural levels, I have an update. We're going to do things a little differently inside the service this month. I'm going to release all the Tier 1, Tier 2, and Tier 3 as the Trading View indicator and then just wrap them up in one video. Kind of like a cheat sheet on steroids. The indicator update for the S&P 500, the DXY, Bitcoin, the US 10-year, and total crypto market cap has been released. To give you an idea on volatility, we had unexpected job growth of 353,000. There was an expectation that the labor market might actually cool down. It's not done that. It's done the opposite. Already, Fed officials are coming out of the woodwork saying, oh, it's nothing to worry about. How did the main market react to this news? Wow, we got a spike in the yields, a spike in the DXY, which tanked bond prices and smacked gold around the head. Fortunately, the VIX didn't increase, so we had positive momentum inside the major indices. Or did we? No, we didn't, because as soon as the market closed up, the futures went negative. You can see all these retracements coming through at the current time. We know Bitcoin cannot escape the stock market's gravity. As yields came up, the DXY came up. What happened to Bitcoin? It's been coming down. What about Ethereum? Of course, it's coming down because the alts can't escape Bitcoin's gravity either. Binance Coin coming down, Solana, XRP coming down. Ooh, Cardano doing a little bit of inversion. That's pretty nice. AVAX coming down and Doge coming down. We always look for inverters. The January non-farm payroll numbers were very impressive. We got a big boost up. Now, what did that mean and why did the markets react the way they did? We saw hourly earnings coming up. We saw a lot of employment in the healthcare sector, a reduction in government. Yeah, that's a good thing. Leisure and hospitality actually decreased, and that's not so good. That's going to throw pressure on those companies. As well as that, we saw retail. Retail is the lifeblood of consumer spending. This could point to a bit of a slowdown in the GDP numbers. unless it's offset by good producing, professional services and all remaining services. After the bell on Thursday, Apple, Amazon and Meta reported their earnings. And it doesn't take much to see that the street really like Meta earnings and Amazon earnings. On the day, Tesla was down just a fraction. This was on the news that Tesla needs to recall over 2 million EVs. This is regarding the small font size on critical safety information on the instrumentation panel. Volatility isn't a bad thing at all. If you know your structural levels, if you know the Tier 1, Tier 2 and Tier 3 interdependencies, you would have already seen that the spike in the yields, especially the 10-year, was very much on the cards. If the markets get volatile, you must know your structural levels. Why could they get volatile? If we look at the per share earnings of Alphabet, the parent company of Google, we can see the Q4 earnings have come in, but Q1 2024 are likely to decrease. You can expect some negative price momentum during that period, with a recovery later. What about Microsoft? It's a very valuable company. What about Q3 earnings? Not looking too good. Q4 is looking better. This is the very definition of variability coming through. What about Apple Inc? When we look at Apple, we can see the Q2 and Q3 earnings are pointing negative. This is not a good sign. Apple is a very major part of the Magnificent Seven. What about Meta platforms? We can see some negative action followed by some positive action. We expect volatility in Q1 of 2024. What about Amazon Inc? We can see a bit of a flat line, a little bit less volatility. But when you're looking at other big techs that have substantial volatility and negative momentum, such as Apple, that's not so good. When it comes to volatility, what can we expect? We've seen the NASDAQ and other major indices just absolutely going for it. If they get volatile, what do we anticipate? We anticipate a pullback. If we get a pullback, this is just normalized price reaction. And we can see that there's a very nice uptrend that's developing right across all the major components. But what does it mean? If we get a pullback, that means that a lot of people are absolutely going to freak out and they're going to sell down. More importantly, there's so much optimism inside the markets that they probably don't even think a sell down is in any way possible. We never think that way because we have three simultaneous strategies playing out at all times. We have a negative strategy, a neutral strategy, and an up strategy playing out simultaneously. We know we control the trade or investment, but the market controls the returns. The key factor for us is just to get synchronized in with the market. If we get synchronized, we're going to make money. The only real way to get synchronized is to understand where the structural levels are. The next most important thing is to have these three simultaneous strategies playing out at all times. You must be prepared for downward price momentum. You must be prepared for neutral price momentum and upwards price momentum. And you must be prepared at the same time. It literally doesn't matter what the market is. We seek to buy on the right side of the percentage and to sell on the right side of the percentage. You can see the price is always moving in a wave-like fashion. This is common for financial markets. When it's doing this, what we just do is just know where the structural levels are, because it's the structural levels that help us to understand where price can come down to and rebound. And price is always moving structural level to structural level, structural level to structural level in a wave function. Therefore, all we need to do is to buy on red. What is buy on red? As the price is coming down, we're buying on red with an understanding of the structural levels inherent in what we're looking at. And where do we sell? As a trader and an investor, we sell on green as the price is coming up. This is rampantly difficult to do because what happens when a structural level is hit and it rebounds and goes positive, people get euphoric. They just expect the price to go and go and go. It's going to go to a structural level. It's also vital to know the interdependencies and intercorrelations between things. If the DXY is going up, what's going to happen to the US 10-year yield? It's in all probability coming up, and the 2-year is coming up. If they come up, what's going to happen to gold? You got it. What's going to happen to silver? You got it. They're going to go down. What is likely to happen to Bitcoin? If the DXY is going up, the US 2-year and the US 10-year, Bitcoin is likely to come down. If the DXY, the US 10, the US 2 is going downwards, what is likely to happen to the S&P 500? They're likely to come up. But if they're coming up, the US 10, the US 2, the DXY, they're likely to instead go down. Just remember these associations. They're vital to understand. For example, if Bitcoin is going up, which is that blue line, what is likely to happen to, for example, Ethereum here? Is it likely to go up? You bet it is. What if it just makes its way up like that? Yeah, it's likely to go up. This is why you must keep your eye on Bitcoin. If Bitcoin is coming down, where are the alts likely to go? They're likely to come down. This is a very important aspect of the crypto market. If Bitcoin is coming down, you have a very high probability of 99% of the alts to follow. And when they follow by greater percentages, both down and up. We love the alts when they go up by big percentages, but just be aware they can come down by big percentages as well. When looking at Bitcoin, it's very important to understand that all price momentum is structurally level bound. That means if price is coming down, it's coming down and interacting with structural levels. If price is going up, it's interacting with structural levels. So let's zoom in to this recent price action and see where the structural levels are. Price is always moving structural level to structural level. If it can't get above a structural level, it's coming back. And sometimes what you will find is it can hover around for a period of time before it makes up its mind, either to go up to the next structural level or down to the next structural level. But price is always moving between structural levels. When you understand this factor, the whole of financial markets become much easier to understand. For example, we can see that we rejected this particular structural level here. And what happened next? We came down to a level of structure and we started losing it. If we're starting to lose a level of structure, we're heading down to the next level. But that also means that we're likely to come back up to the previous level. At the moment, we're stuck between a rock and a hard place. We're either going to go up or going to go down. But the idea is we know what the numbers are underneath this. We're simply not guessing. Why aren't we guessing? Because we've marked up with level 1 and level 2 standard certification all of price history in excess of 5,200 days. If you go across to ctksmethod.org, you can learn to draw up your own levels. We can see that lower level of support is $41,963, and Bitcoin is currently $43,070. The upper resistance level is 43,847. These are the two key levels that you want to keep your eye on. Given what's happening inside the main market and crypto cannot escape the stock market's gravity, please let me know, where do you think we're headed to next? You can see that Bitcoin was pinging between structural levels, and all charts do exactly what Bitcoin does. Not in the same percentages, but all charts are moving between structural support and structural resistance levels. This is exactly why we buy on red. Buying on red is a powerful, powerful thing. If you buy on the red days, you're just going to get on the right side of the percentage as price recovers. But as Tales from the Man Cave says, this is very difficult to do. It's important to have dry powder available. When you have dry powder, it means that you have cash ready to deploy. If you go all in one level, it means you have one shot. And if you don't know where the structural levels are, you're just guessing, and you're probably guessing at the wrong time. That's why you fraction off your structural levels, your buy levels at structural areas. As an example, if you were trading inside Bitcoin, knowing where the structure is and knowing that we were losing support and the probability of going to a lower structural level was on the cards, it becomes a very good idea to place your buy areas at or around structural support levels. If you do this, you're actually buying when the price goes red. You're buying on red or boring. Haha, you're not boring at all. You're very interesting. But the concept is buy on red, sell on green is a license to profitability. But you must know what you're doing. Always remember Rule 214, red days create opportunities, and boy oh boy do they. But you must be prepared. Unfortunately, our brains are wired. When the price is going up, we want to pile in, which creates an enormous amount of problems. When you want certainty out of financial markets, you will experience terror. And if you only go in at one level, you're just like a light switch. It's more important to go in at multiple levels, just like a dimmer. If you're inside Zone 1 and Zone 2, which just means that you're just starting your trading and investing journey, you'll think a lot about diamond hands, but the problem is, if you're panicking, you simply don't know the structural levels. If you're blaming, you don't know that the market is just simply handing you a lesson through a specific loss. We don't like getting those kind of lessons, but everybody does, and there's nothing wrong with them. They make you stronger. Therefore, when you learn the lessons, you take the bridge between Zone 1 and Zone 2 and Zone 3 and Zone 4. Coming down from Zone 2 into Zone 3, you learn about patience and rules, getting on the right side of the percentages, understanding how the market actually works, and it always works in terms of probability and also rules. You can move away from the concepts of perfect timing, impatience, one-way decisions, buying on green and selling on red. That's the fastest way to suffer the death of 1,000 cuts. A lot of people go all in or all out. You'll find when you get down to Zone 3 and Zone 4, you don't do any of these behaviors. It's a completely different way of thinking. As the markets get turbulent, you're going to get unexpected negative outcomes, which are losses, which will upset you until you gain insight. When you gain insight, when you gain awareness and understanding of what's going on, you will not be angry or hurt. You will not enter the doom cycle where you just reach out and blame. You don't want to do that because you're compounding your losses. Instead of learning, we're blaming, and when we blame, we're always disempowered. Anger is not strength, it's weakness. And also, how we do one thing is how we do all things. If we can't control ourselves inside financial markets, we're probably not controlling ourselves anywhere else. But the other thing is, if we can control ourselves in the hardest markets that exist, which are financial markets, you can control yourself everywhere. And that means success is right smack bang on your doorstep. The concept is, when you lose, don't lose the lessons. The lessons that come from losses are called lessons, and lessons are incredibly valuable. You've paid the price. You don't want to pay it again and again and again. You just want to learn. Typically, what we learn is that buying on green is the surefire way to lose money. Please let me know in the comments, what other lessons could you share with other people to help them out? I'd love to share them. Inside Zone 1 and Zone 2, people don't go from a positive excellence stance, they go from a negative excellence stance. Negative excellence is literally the opposite of all of these things. Instead of kind, they're angry and aggressive. Instead of inner peace and outer peace, there's nothing but conflict and beating a person up from the inside out. With negative excellence, everything is on the outcome. A person just has to earn money, but you only earn money when you learn how to make money. To do that, you must have humility and you must have patience. You must have respect for the market. The market doesn't know you and it never will. It's always giving you lessons that you can learn from. The key is to keep those costs down. With positive excellence, money and success are outcomes of a process. They're not inputs. You cannot be successful up front. You have to put in the hard work. You have to understand what you're doing. The fastest way to understand everything is just simply to understand the structure across the Tier 1 charts, the Tier 2 charts, and the Tier 3 charts. All of these charts are intercorrelated and interdependent. We've seen recently that Apple was losing steam. That pointed to weakness inside the main markets. And we've seen Tesla come down and down and down. Unfortunately for Tesla, there are other problems at hand. But if you know where the structural levels are, they're not problems at hand, they're opportunities. Inside Zone 1 and Zone 2, people look at negative price momentum as a huge problem. It's not a huge problem, it's a huge advantage, but only if you know the structural levels. If you would like to get the structural levels across all of these Tier 1, Tier 2, and Tier 3 charts as a separate trading view indicator for each chart, just go across to ctksmethod.org. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.